The physical silver shortage isn't coming. It's already here. 37.6 million ounces vanished from registered vaults in 47 days. That's 47% of all registered silver gone. And while the headlines told you inflation was cooling and the markets were stable, the vault receipts were being rewritten in real time. You see, most people believe silver is just an industrial metal, a commodity for solar panels and circuit boards, something the market price is efficiently based on supply and demand. But here's what they aren't telling you. Silver isn't just a metal. It's a mathematical bottleneck for the entire green energy grid and the banking system that finances it. Every electric vehicle needs 0.8 ounces. Every solar panel array needs 200 ounces. Every data center expansion needs thousands. Which means the more the system tries to go green, the faster it drains the one resource it can't print, synthesize, or replace. Today, I'm walking you through the three-stage extraction mechanism that just broke the paper silver market. Stage 1, the vault drain. Stage 2, the legal trap hidden in your brokerage account. Stage 3, the 2026 deadline that makes all of this inevitable. A mandatory protocol before we open the file. This is not financial advice. I am not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. Let's start with the data. 37.6 million ounces disappeared from the Comex registered vaults between September and November of 2025. Registered silver is the physical metal available for delivery against futures contracts. It's the backbone of the paper market. It's the collateral that makes the entire pricing mechanism work. 47% of it vanished in 47 days. You see, the Comex operates on a two-tier system. There's eligible silver, which is stored in the vault but not available for delivery. And there's registered silver, which is marked for delivery and actively backing paper contracts. When registered silver gets drained, it means someone is demanding physical metal, and the vault is running out of inventory to hand over. The official explanation? Industrial demand, solar panel manufacturers, electric vehicle supply chains, normal market activity. But here's the mechanism they aren't telling you about. The commercial real estate maturity wall of 2026 is forcing banks to liquidate paper hedges to cover physical losses. You see, major banks use silver futures as collateral hedges against their commercial real estate loan books. When those loans started defaulting in late 2024, the banks needed liquid capital. Fast, which means they had to close out their paper silver positions and deliver physical metal to counterparties who demanded settlement. Plus, the vault drain isn't evenly distributed. 3 bullion banks account for 72% of the outflows, which means this isn't a broad industrial trend. It's a targeted extraction by entities that know the paper price is about to decouple from the physical price. The math is simple. The Comex has roughly 32 million ounces of registered silver left as of early January 2026. Global industrial demand is running at 1.1 billion ounces per year. The US Mint alone consumed 14 million ounces in 2024, which means at current drain rates, the registered vaults will be empty by late March. Your paper silver ETFs, your futures contracts, your brokerage statements that show you own silver, you're holding a promise the vaults can no longer keep. Now, if this vault extraction mechanism just clicked for you, or you want to track these forensic breakdowns as they happen, join the circle by hitting subscribe. We hold ourselves to a different standard here. Let's keep moving. But even this vault drain is a distraction from the real trap. Because the physical shortage isn't the problem. The problem is the legal structure that was designed to make sure you never see the metal you think you own. And it's buried in a law most people have never heard of, one that turns you into an unsecured creditor the moment you buy paper silver. I'll show you the exact legal code in 60 seconds. The paper silver market operates on a leverage ratio of approximately 250 to 1, which means for every 1 ounce of physical silver in the vault, there are 250 paper claims against it. Futures contracts, ETFs, unallocated accounts, certificates of ownership that exist only as digital entries in a brokerage database. You see, the price you see on your screen isn't the price of physical silver. It's the price of a derivative contract that settles in cash 98% of the time. The physical metal almost never changes hands. The contract just expires, gets rolled over, or gets closed out for a cash payment based on the paper price. Which means the price discovery mechanism is completely divorced from physical supply and demand. Here's how the extraction works. When industrial demand spikes, or a sovereign buyer enters the market demanding physical delivery, the bullion banks don't go into the vault and pull metal. They open short positions on the futures market to suppress the price. They flood the market with sell orders during low liquidity windows, typically between 2 a.m. and 4 a.m. New York time, when most retail traders are asleep. The price drops, panic sellers exit their positions, and the banks cover their shorts at a profit while simultaneously purchasing physical metal at the suppressed price. It's a high-frequency arbitrage script. Suppress the paper price. Buy the physical metal. Deliver to the client. Repeat. But here's what changed in late 2025. The vault inventory dropped below the threshold needed to sustain the leverage ratio, which means the bullion banks could no longer suppress the paper price without risking a delivery default. And that's when the system broke. On November 18th, 2025, the silver market entered backwardation for the first time since 1980. Backwardation means the spot price of physical silver is now higher than the futures price. In a normal market, the futures price is always higher than the spot price because of storage costs, insurance, and the time value of money. You pay a premium to lock in a future delivery. But when backwardation occurs, it signals one thing. The market believes physical metal will be harder to obtain in the future than it is today. You see, backwardation is the market's way of screaming that the paper contracts are no longer trusted. Buyers are willing to pay more for immediate physical delivery than they are for a promise of delivery 6 months from now, which means the paper price has officially decoupled from the physical price. And this isn't a temporary anomaly. The backwardation has persisted for 63 consecutive trading days as of mid-January 2026. Every single day, the spot price trades at a premium to the futures price. Every single day, the market is telling you the same thing. Physical silver is worth more than the paper contract that claims to represent it. Plus, the premiums on physical delivery have exploded. In September 2025, you could buy a 1,000-ounce Comex bar at spot price plus 1%. By December, the premium was 8%. By early January 2026, dealers were quoting 12 to 15% premiums for immediate delivery, which means if the paper price says silver is $30 per ounce, the real price for physical metal you can actually hold is $34.50. The paper market is a lie, and the physical market just exposed it. Now, here's the mechanism that makes this extraction legal. Uniform Commercial Code. Article 8 governs how securities are held in brokerage accounts. And buried in Section 501 is a provision that redefines ownership in a way most people never see coming. When you buy silver through an ETF or a brokerage account, you don't actually own the metal. You own a security entitlement, which means you have a claim against the brokerage for the value of the asset, but you don't have direct ownership of the underlying metal. You see, under UCC Article 8, the brokerage holds the metal in a pooled account. You're listed as a beneficial owner, but the legal title belongs to the custodian, which means if the brokerage goes into bankruptcy or liquidation, you become an unsecured creditor. You get in line with everyone else who has a claim against the firm's assets. And here's the kicker. In a systemic crisis, unsecured creditors are the last to get paid. Secured creditors and derivative counterparties get priority. By the time the bankruptcy court gets to you, the vaults are empty and you're left holding a legal claim against an insolvent entity. This isn't a conspiracy theory. This is black-letter law. UCC Article 8, Section 501, subsection B. You can read it yourself, which means every paper claim you hold, every ETF share, every unallocated account, every futures contract that hasn't been converted to physical delivery is a legal time bomb that detonates the moment the system enters a liquidity crisis. Everything changed at 2:32 p.m. Eastern Time on May 4th, 2025. That's when the first major bullion bank triggered a force majeure clause in its silver delivery contracts. Force majeure is a legal provision that allows a party to suspend or terminate a contract due to extraordinary circumstances beyond their control. Natural disasters, war, government intervention, acts of God. But in this case, the extraordinary circumstance was a vault inventory shortage. The bank notified its counterparties that it could no longer guarantee physical delivery on existing futures contracts due to unforeseen supply chain disruptions and regulatory constraints, which is legal code for we don't have the metal and we're not going to default, so we're invoking the escape clause. You see, force majeure clauses are buried in the fine print of every futures contract and unallocated account agreement. Most traders never read them. Most don't even know they exist. But the moment a bank triggers that clause, your contract converts from a guarantee of physical delivery to a cash settlement based on the paper price, which means you don't get the metal. You get paid out in dollars at the suppressed paper price, even though the physical price is trading 12% higher. It's legalized theft, and it's happening in real time. Plus, this wasn't an isolated event. Within 72 hours of the first force majeure trigger, 3 additional bullion banks issued similar notices, which means this is a coordinated extraction, not a market anomaly. Now here's where it ties into the banking crisis. Title II of the Dodd-Frank Act gives the FDIC the authority to seize and liquidate systemically important financial institutions during a crisis. And buried in Section 204 is a provision that allows the FDIC to convert unsecured liabilities into equity, which means if a major bullion bank enters receivership, your unallocated silver account, which is classified as an unsecured liability under UCC Article 8, can be converted into equity shares of a failing institution. You don't get your silver, you get stock in a bankrupt bank. This is the same mechanism that was used in Cyprus in 2013 when depositors had their savings seized to recapitalize failing banks. It's called a bail-in, and it's now codified in U.S. law under Dodd-Frank Title II. You see, the 2026 commercial real estate maturity wall isn't just a real estate problem. It's a banking crisis that will trigger Dodd-Frank receivership protocols. And when those banks go down, every unsecured claim against them, including your paper silver holdings, becomes fodder for the bail-in, the vault drain, the backwardation, the force majeure clauses, the UCC Article 8 reclassification. These aren't separate events. They're stages in a single extraction mechanism designed to transfer physical wealth from paper holders to the entities that control the vaults. But even this legal trap is just the surface, because the real question isn't whether the paper market will collapse. The question is, why now? Why is this happening in 2026 specifically? And the answer is hidden in a 7-stage pattern that has destroyed every empire in history. A pattern the US just entered at stage 5. I'll show you the exact timeline in 90 seconds. This has happened before, not just once, 3 times in recorded history. And the script is always the same. Stage 1, the empire controls the global reserve asset. For Rome, it was grain. For Spain, it was silver. For Britain, it was gold. For the United States, it's the dollar. Stage 2, the empire finances expansion through debt, military spending, infrastructure projects, social programs. The debt grows faster than the economy because the reserve currency allows the empire to borrow without immediate consequences. Stage 3, the currency begins to debase, not through official policy, but through systemic dilution. Rome clipped coins, Spain inflated the silver supply, Britain printed sterling to finance World War I. The US has expanded the money supply by $38 trillion since 2008. Stage 4, wealth concentration accelerates. The asset-holding class benefits from currency debasement while wage earners see their purchasing power erode. The Gini coefficient spikes, social tension rises, trust in institutions collapses. Stage 5, money printing and asset bubbles. This is where we are now. The central bank is trapped. It can't raise rates without collapsing the debt structure. It can't lower rates without triggering hyperinflation. So it prints, and the excess liquidity flows into assets, real estate, equities, and increasingly hard commodities like silver and gold. Stage 6, the flight to hard assets. When the public loses faith in the currency, they exit en masse into physical stores of value. This is the phase where gold and silver prices go parabolic, where shortages become permanent, where governments impose capital controls and export bans to stop the bleeding. Stage 7, the reset. The old currency collapses, a new system is imposed, and the cycle begins again with a different empire holding the reserve asset. You see, the US entered stage 5 in March of 2020 when the Federal Reserve launched unlimited quantitative easing. The asset bubbles are here, the wealth gap is here, and the flight to hard assets is beginning. Silver isn't just a commodity play, it's the stage 6 canary in the coal mine. Let's walk through the first case study. In 1545, Spain discovered the silver mines of Potosi in modern-day Bolivia. It was the largest silver deposit ever found. Within 50 years, Spain was extracting over 3 million ounces of silver per year and shipping it back to Europe to finance wars, palaces, and a global empire. But here's what happened. The silver flooded the European economy. Prices doubled, then tripled. The Spanish crown used the metal to mint coins and pay soldiers, but the more silver they minted, the less each coin was worth. By 1590, Spain was experiencing what we would now call hyperinflation. The price of bread in Seville increased by 400% in 30 years. Plus, the empire was hemorrhaging silver faster than it could mine it. Spain was fighting wars in the Netherlands, France, and the Mediterranean. Every military campaign required silver to pay troops and buy supplies. And by the late 1590s, the Potosi mines were running dry. Production dropped. The vaults emptied. And Spain defaulted on its debts in 1596. The silver standard collapsed. The empire collapsed. And within a century, Spain went from the world's dominant superpower to a regional power struggling with internal bankruptcy. You see, Spain didn't run out of silver because the mines were empty. They ran out of silver because the debt structure required more metal than the system could produce. The empire was mathematically insolvent the moment the debt exceeded the physical supply of the reserve asset. Sound familiar? Fast forward 300 years. In 1816, Britain officially adopted the gold standard. Every pound sterling could be redeemed for a fixed amount of gold. The system worked because Britain controlled the largest gold reserves in the world and maintained a trade surplus that continually replenished the vaults. But then came World War I. Britain financed the war by printing sterling and borrowing heavily from the United States. By 1918, the pound had lost 40% of its value against gold. The vaults were drained to pay for munitions, ships, and soldiers, and Britain was forced to suspend the gold standard in 1919 because it no longer had the physical metal to back the currency. The empire tried to return to the gold standard in 1925 at the pre-war exchange rate, but the economy couldn't support it. Deflation set in, unemployment spiked, and by 1931, Britain permanently abandoned the gold standard and devalued the pound by 30%, which means the reserve currency of the British Empire collapsed in 12 years, from 1919 to 1931. And the moment the pound lost its gold backing, the global reserve currency shifted to the US dollar. You see, the pattern is always the same. The empire finances expansion through debt. The debt exceeds the physical reserves. The vaults drain. The currency collapses. And a new empire takes over. Now let's bring this to the United States. In 1873, the U.S. Congress passed the Coinage Act, which demonetized silver and placed the country exclusively on a gold standard. It was called the Crime of 1873 by silver advocates because it effectively removed 50% of the monetary base from circulation overnight. You see, silver had been used as legal tender alongside gold since the founding of the Republic. But by the 1870s, powerful banking interests wanted to consolidate control over the money supply. Gold was easier to centralize. Silver was too abundant and too distributed among rural farmers and miners. So Congress quietly removed silver from the monetary system. Prices collapsed. Farmers who had borrowed in silver-backed currency were forced to repay in gold-backed currency that was worth twice as much. Foreclosures spiked, and the wealth transfer from rural America to coastal banking centers was complete. Plus, the demonetization of silver crashed the price from $1.29 per ounce in 1872 to 63 cents per ounce by 1876, a 51% collapse in 4 years. The lesson? When the system needs to extract wealth, it changes the rules, and silver has always been the target. The last time anyone tried to corner the physical silver market was 1980. Nelson Bunker Hunt and William Herbert Hunt, two Texas oil billionaires, accumulated over 200 million ounces of physical silver between 1973 and 1980. Their thesis was simple. The U.S. had abandoned the gold standard in 1971. Inflation was running at 13%, and silver was the most undervalued hard asset in the world. By January of 1980, the Hunt brothers controlled over half of the world's deliverable silver supply. The price spiked from $6 per ounce in 1979 to $50.35 per ounce in January 1980. But then the system intervened. The Comex changed the rules. They imposed Silver Rule 7, which banned new long positions and required liquidation-only trading. The Federal Reserve pressured banks to stop lending against silver collateral, and the price collapsed to $10.80 per ounce by March 1980. The Hunt brothers were wiped out. They filed for bankruptcy in 1988. You see, the system will tolerate price discovery until physical accumulation threatens the paper market's control. And then the rules change. Overnight. The United States is at stage 5 of the imperial collapse pattern. Money printing and asset bubbles. The Federal Reserve has expanded its balance sheet from $800 billion in 2007 to $8.9 trillion in 2024. The M2 money supply has increased by 94% since 2008, and the excess liquidity is flooding into assets, real estate, equities, cryptocurrencies, and now, physical silver. The 2026 commercial real estate maturity wall is the catalyst. $1.5 trillion in commercial real estate loans come due between January and December of 2026. Most of those properties are underwater. The banks holding those loans are insolvent, and the Federal Reserve will have to choose between letting the banks fail or printing another $5 trillion to backstop the losses. Either way, stage 6 begins. The flight to hard assets. And when the public realizes the vaults are empty, the paper price will be irrelevant. The only price that will matter is the price of physical metal you can hold in your hand. The Spanish Empire collapsed when the silver ran out. The British Empire collapsed when the gold ran out. The U.S. Empire will collapse when the dollar's credibility runs out, and silver is the mathematical proof that we're already there. But here's the final question. What do you do about it? Because the timeline is set, the maturity wall is locked, and the math is no longer debatable. I'll give you the forensic conclusion in 60 seconds. The vault drain is real. The backwardation is confirmed. The legal trap is codified in UCC Article 8 and Dodd-Frank Title II, and the 2026 maturity wall is locked in, which means the paper silver market has approximately 60 to 90 days before the registered vaults hit zero. And when that happens, the price discovery mechanism breaks permanently. You see, most people will ignore this data. They'll keep holding paper claims. They'll trust the system to honor contracts that the vaults can no longer fulfill. And they'll pay the price when force majeure clauses convert their metal into cash settlements at suppressed prices. But if you're the type of person who refuses to be a victim of the script, if you understand that the cycle doesn't care about exceptionalism or hope, then you're already ahead of 99% of the market. Now, the 2026 timeline doesn't stop at silver. The Social Security Trust Fund hits depletion in 2033, according to official projections. But the math says it's actually insolvent by 2027 when you account for the real inflation rate and the commercial real estate losses bleeding into Treasury receipts. I'm writing a full forensic autopsy on that right now. The mechanism, the legal structure, and the exact date the checks stop clearing. Make sure you're subscribed so you don't miss it when it drops. This circle holds itself to a different standard. Here's the summary. Silver will hit $100 per ounce by late 2026. Not because of speculation, not because of hype, but because the math is no longer sustainable. The system isn't broken. It was designed to extract your purchasing power the moment you trusted paper over metal. And by the time the vaults are empty, the only people left holding value will be the ones who saw the script before it finished playing. The data is public, the timeline is set, and the cycle is inevitable. Your move.